Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate filings. Today we are looking at a report from Biopharma, and let me tell you, their financial situation is a bit like a roller coaster ride. It's got its ups, it's got its downs, and you might need a strong stomach to get through it. Think of it as a biotech startup trying to stay afloat in a sea of expenses. First off, Biopharma has entered into an agreement, basically a deal on paper, with some underwriters. These underwriters, led by Oppenheimer & Co. Inc., will help them sell shares and something called warrants. Think of warrants as coupons to buy more shares later. They're selling two types of these deals, one with regular shares of stock and the other with something called pre-funded warrants, which are a bit like shares you pay for now but get later at a discount. In total, we are talking about millions of shares and warrants being offered to investors. I'm first of in two types of these deals, one with regular shares of stock and the other with something called pre-funded warrants, which are a bit like shares you pay for now but get later at a discount. In total, we are talking about millions of shares and warrants being offered to investors. To get more specific, Biopharma plans to sell about 13.5 million shares of their common stock, along with warrants to buy about 3.4 million more shares. Then for some investors, they're offering pre-funded warrants to buy about 11.5 million shares, with another set of warrants to buy about 2.9 million shares alongside those. All these shares and warrants are being sold by the company itself to raise money. Each share comes with a warrant and costs about 79 cents together. So you get a share and a potential future share for less than $1. The other deal, the pre-funded warrant with its warrant, goes for a hair less, about 78.9 cents. The underwriters, who are like the salespeople in this situation, get a slightly better price when they buy these deals from Biopharma. They buy the share and warrant combo for around 74 cents and the pre-funded warrant combo for a tiny bit less than that. After all is said and done, Biopharma figures they'll get around $18 million from this offering. That's after they pay the underwriters and cover the costs of doing the deal, but it doesn't include any extra money they might get if people actually use those warrants to buy more shares down the road. These shares and warrants are being issued under a previous agreement with the Securities and Exchange Commission, the SEC, kind of like getting permission slips ahead of time. They expect to close this deal around mid-April, assuming everything goes as planned. Now let's talk about these pre-funded warrants a little more. They come with a super low exercise price, just a tiny fraction of a penny per share. These pre-funded warrants can be used right away without even needing cash in some cases. But there's a catch: someone can't use these warrants to become too big of an owner. They can choose to limit their ownership to either 4.99% or 9.99% or 9.99% or 9.99% or 9.99% or 9.9% or 9.99% of the company. They can increase this up to 19.999% or 9.99% or 9.99% or 9.99% or 9.99% of the company. They can increase this up to 19.90 takeover. The warrant holders get to cash in as if they used their warrants right before the deal. The regular warrants or common stock warrants have an exercise price of 79 cents. You can use them for 5 years after they are issued. You usually need cash to use these warrants unless the company hasn't registered the shares with the SEC yet, in which case you can do a cashless exercise. These warrants also have rules about big changes at the company, and they also limit how much of the company someone can own. Similar to the pre-funded warrants, the agreement with the underwriters has all the usual promises and protections. The company promises they're being honest, and both sides protect each other from potential legal problems. Keep in mind that these promises are just for disagreement and might be limited by some private details shared between the company and the underwriters. Okay, let's get into the really important stuff, the money. As of the end of March, the company thinks they had around $13 in cash. But remember, this is just an estimate. The real numbers might be different after they finish their financial paperwork for the quarter. So this number is preliminary, like a sneak peek before the final show. The company put out a press release about this stock offering, and you can find the full text of it as an exhibit or attachment to this report. Now, based on what they know today, Biopharma believes the money from this stock offering, along with their existing cash and a payment from a deal with Boehringer Ingelheim, should keep them going until the second quarter of 2026. But things can change. This estimate is based on their current plans and spending, and those could easily change. They might end up needing more money sooner than they think. There are also some legal documents attached, including the opinion of their lawyers, Wilmer Cutler, Pickering, Hale, and Dorel, in the legality of these shares and warrants. Finally, there's some computer code attached formatted as inline XBRL for those who want to dig deep into the data. So what can we summarize from all this? Biopharma needs cash, and they are getting it by selling shares and warrants. They think this will give them enough money to keep operating for about another year, but it's an estimate. Now for my take, Biopharma is a company that is clearly in need of funds. This is no secret. The fact that they are resorting to selling shares and warrants tells you that they are burning cash quickly and that investors might not be lining up to give them money directly. The deal with Boehringer Ingelheim provides some relief, but it's not a long-term solution. The company needs to show progress in their research and development efforts to become more attractive to investors and avoid constantly diluting their stock. While their technology might be promising, the financial situation adds a layer of risk that investors should carefully consider. It is difficult to assess a target price for the stock because it depends so much on future progress and potential partnerships that are not yet in place. Thanks for watching. If you found this breakdown helpful, give us a like, leave a comment, and subscribe for more Corporate Decoder.